Now, I want to start off by talking about the Malaysian ringgit first. From the 25th of July, the ringgit has gained 6.23% against the US dollar to a 16-month high of 4.40, this point over here, in just 11 days. So ringgit strength, not only against US dollar, against all currencies in general. Against the British pound, ringgit rallied below 6 ringgit to 5.6504. Sing dollar 3.3392. The euro rallied below 5 ringgit, in fact, 4.8466. So I'm not going to go through the reasons and details as to why we are seeing this. It's related to Bank Negara Malaysia maintaining the overnight policy rate, plus over at the US, the Federal Reserve is scheduled to reduce interest rates, but it's a very long story. But I do want to talk about diversification. So for those who are close to retirement and are planning to retire in Malaysia, right, you should always have a significant portion of your portfolio allocated in Malaysian assets slash equities. Even if you're young, 20 to 30 years away from retirement, you want to invest in growth stocks, such as Apple, Netflix, the US side, sure, you can do that. But make sure you have a large portion, or at least a significant portion of your portfolio allocated in Malaysian assets. Otherwise, in cases like this, if you have the majority of your portfolio in the US dollar, in US stocks, right, then you will most certainly face a huge downturn. You most certainly face a huge unrealized loss within your portfolio. And cases like this have happened multiple times in the past. The previous time that this occurred, where the ringgit strengthened over 6 to 7%, was in November 2022. That was coincidentally when Anwar won the election. So we talked about this and more actually last week in our X Space with two financial experts, Han Liu and Sunny Hamid. You can listen to the replay right now. It's available on Spotify already. Let's move on over to the global markets. On Monday, S&P fell 4.53%, its worst day since 2022. FBM KLCI previously took 3 months to reach a 3-year high, and all the gains were erased in only 2 days, on Monday and Tuesday. It faced one of the worst drops since the March 2020 COVID pandemic crash. Bitcoin, previously hailed as an asset, actually still hailed as an asset with negative correlation to stock markets, right? It was not spared also. It tumbled 20% in a single day, below $50,000, its lowest level since February. And we take a look at the Magnificent Seven stocks, such as Meta, Google, Netflix, Apple, right? $1 trillion was wiped out. And this comes as Warren Buffett's Berkshire Hathaway, they dumped over 50% of their stake in Apple. And the reasons for this sell-off? Well, it's due to recession fears. Over the US, weak jobs reports, shrinking manufacturing activity, heightened fears that the leading economy of the world may be heading into a recession. Goldman Sachs, they've increased the chances of a US recession by 10 points to 25%. And you combine that with dismal forecasts, as well as overvaluation in tech firms. Since the start of the year, the S&P has made consecutively new all-time highs every month. And with this new AI hype, this type of thing, right, people believe, or the markets are starting to believe, that these companies are very overvalued. Hence the big sell-off. And also, markets believe that the Federal Reserve may be too late for interest rate cuts. Over the US right now, interest rates are easily at a 2-decade high. So this is hampering growth for the US economy, which is why Wall Street believe that it's about time for the Federal Reserve to start to cut interest rates. So recession, it's a bad thing. Unemployment rises, people run out of jobs, people don't have jobs, people lose their homes, businesses go bankrupt, young people can't get a good job after school, which is why a lot of fear came in on Monday and Tuesday, leading to the huge sell-off. And another big reason for the sell-off is carry trade. This one is a bit of a technical term, but put simply, right, it involves borrowing cheaper money or a currency with low interest rates and investing them in an asset that generates a higher return, or perhaps an asset that has higher interest rates. And for decades, investors have relied on the Japanese yen as a source of cheap money. And why is this the case? Because Japanese interest rates were kept ultra low. In the past 4 years, they were in negative territory, negative 0.1%. This means you can borrow the Japanese yen from little to no cost and then invest it in US treasuries and bonds, and at a point of time they were giving 5 to 6%. So that's basically free money, because apart from earning the 5 to 6% from US treasuries and bonds, you will also earn from FX. Yeah, as long as the Japanese yen remains weak against the US dollar, and we all know the history of the Japanese yen, it has performed very bad in the recent 5 to 10 years because of its extremely low interest rates, then investors could effectively make double profits. Yeah, one profit is from investing in US treasuries and bonds, the other profit is from the gains in FX. But now everything is beginning to unwind. Everything is beginning to crash because Japan recently they've raised interest rates for the first time in 17 years. So March they raised one time to 0 to 0.1%, and July they raised another time. So that's why if you look at this chart over here, you see two bump up, right? Which means that Japan has raised interest rates two times to 0.25%. And meanwhile, over at the US, right, the Federal Reserve, due to fears of a recession, like what I said just now, right, Federal Reserve may be too late in cutting interest rates, right? They've hinted strongly that they are going to cut interest rates as soon as September. So you can see the difference over here, or the technical term like interest rate differential, is narrowing, which has caused the Japanese yen to appreciate significantly against the US dollar. Yeah, if you looked at the Japanese yen, you know what's going on, all right? It has appreciated by over 12% against USD in the past 30 days alone, and that's all because of the unwinding, Japanese central bank raising interest rates, US central bank reducing interest rates, right? So those people that are involved in the carry trade, they borrowed money, their profits started to diminish, and they are forced to repay back their loans. Margin call is happening, right? Which caused this massive sell-off on Monday and Tuesday. So it's a bit of a long story, but since then, markets have rebounded strongly. At 3.18% on Thursday, in fact, best day for the S&P since 2022 again. FBM KLCI rebounded 3.9%. Bitcoin, previously $49,000, jumped almost 13% to $61,000, in fact. Really just shows how volatile the market can be. And the reason for this rebound is because of the US again. Their latest weekly jobless claims came in below forecast, which in simple terms, it means that less people are getting unemployed, which is helping to ease concerns of a recession. Now, my point here being is that markets can be extremely volatile, right? And if you are gambling, if you're investing in a stock hoping that it will go up without any particular strategy, then it's a one-way trip to blow your entire account. Okay, so for traders, make sure you set your stop losses, avoid trading with your emotion, right? But if you're an investor, you want to invest long-term for your retirement, for a wedding, down payment for a car, so on and so forth, right? One of the best strategy is to allocate a specific percentage for each asset within your portfolio. Now, I'll give you an example, okay? Let's say your plan is to allocate 20% into tech stock A, 20% into commodity stock B, another 20% into utility stock C. The remainder of 40%, you invest in other assets such as ASB, ASM, gold, Bitcoin, etc., etc. So the goal is to maintain these percentages as accurately as possible, right? And at the end of the day, you got to determine them yourself. Let's say over the next few months, right, your tech stock A, this one rallies, right, goes up by 20 or 30%. In this case, within your portfolio, it has increased from 20% previously to 30%. And it has squeezed your stock B as well as stock C to 15% respectively. And now you can see, right, your portfolio is out of balance already. Previously, your goal is 20, 20, 20, 40. Now it's 30, 15, 15, 40. So this is a strong signal for you to rebalance, take profits in your tech stock A and allocate them respectively to stock B as well as stock C. And you can see, right, this strategy effectively removes any emotion in the market. You don't even look at the markets anymore. You look at your portfolio and see what your portfolio requires. The question is not whether should I buy this asset right now. No. The question is whether you are overexposed or underexposed. If you're overexposed, like in this case, then rebalance it to whichever asset that is underexposed. I've talked about this many times already, and I don't mind repeating myself because this strategy is actually used by a lot of financial experts as well as portfolio managers worldwide. A bit about Warren Buffett's strategy. He is currently in a record high of cash in hand. His company Berkshire Hathaway, 276.9 billion. It's up from 189 billion in the prior quarter. So that says something about his investing strategy. He may be waiting for an opportune moment. But if you're trying to adopt a similar strategy, and you're not exposed to the asset that you want exposure to. Yeah, let's say your goal is to have 20% invested in the US market, right? And right now you have 0%. The most important thing is to always get a bit of exposure first. Yeah, maybe enter like 5%, 6%, see where the market goes from here. Right? In the next few months, if the market goes up, that's good for you. Right? At least you are already invested. But if the market goes down over the next few months, like this case over here, Monday and Tuesday, it becomes an opportunity for you to allocate more. Now, these percentages, right, you will have to determine them yourself. If you are a high risk investor, you are far away from retirement, 20 to 30 years, you are supposed to take more risk. In this case, you know that you should allocate more into growth stocks, lesser into fixed income assets such as your ASB, ASM, fixed deposits, etc. And right now, I'm going to assume that the majority of you have a lot of your investments in very safe assets, maybe even 50 to 60%. Well, then you're going to lose out on a lot of potential profits because over a long term, a 7 to 8% return every year gives you significantly more returns compared to investing with just like a 4 to 5% return. Where do I start investing in stocks? Any recommendations for a good platform for a new investor investing in stocks? Do I go local first, or can I jump right into the US or other international markets? Okay, so to start investing in stocks, there are so many options these days. You can register with online brokers. There are three: Mumu, M Plus Global, as well as Rakuten. So far, Mumu is the one with the lowest fees, and I've heard from a lot of users that it is also the most interactive and simple to use. So whether to start local or jump into US, this one entirely depends on what you're looking for, right? It doesn't make a lot of difference because at the end of the day, over at the US side, they are major companies. The returns are significantly different, but the investing strategy is the same. Okay, a US side, you get to invest in big companies such as Apple, Amazon, Netflix, Google, right? And you can invest in ETFs that track the S&P 500 index, right? Which is my strategy. I try not to stock pick, okay, because that's a very difficult strategy. You have to look at a company's balance sheet, then analyze the assets versus liabilities. Yeah, for me, I just invest in the entire US market. And that has been generating 8 to 12% returns every year. In fact, since the start of the year, despite falling this much, say on Monday and Tuesday, the S&P is still up about, well, let's see, it's still up about 12.35%. So it's quite significant gain. And the trend is that they typically return 8 to 12% every year. So to get started in investing in US ETFs, I will share you the link right here. There are different types of ETFs that track the US market. So you just need to acquire one. It wouldn't make sense for you to acquire all three, right? Like QQQ, VTI, and VOO, because if you look at the returns, it's pretty much the same. As for Malaysian stocks, well, this one, again, see what you want. There are also a lot of familiar names, right? Maybank, Public Bank, CIMB, Tenaga National. On the Malaysian side, banking stocks, they tend to give very juicy dividends, which is my investing strategy. I also wrote quite extensively about it, right? Dividends, really the easiest form of passive income. So my exposure in the Malaysian market, I do recently have acquired a bit of tech stocks in the Malaysian market, but most of it goes to very passive banking stocks. I just collect dividend annually. And as for Maybank's case, right, they've paid investors 5 to 7% dividends for the past decade. There you can see right here. So it's very juicy okay? You just invest in it, close both of your eyes, and collect your dividends, reinvest your dividends, and you will see your earnings start to compound. So for the Malaysian markets case, in this article, I did mention that I mostly own Public Bank and Maybank because they are the two most significant holdings of EPF. In fact, The five largest holding of EPF, I already memorized it on top of my head. Maybank, CIMB, Tenaga National, Public Bank, and RHB Bank. So 4 out of 5 of EPF's largest investments belongs to banks. So you can really see what sort of strategy they are adopting in the Malaysian market. How would one usually react to rate cuts? Okay, actually this is a fantastic question. Now, we have to understand what interest rate cuts mean. So interest rate cuts basically make borrowing cheaper, right? And then they make saving more expensive because your returns on your FDs, they will generally follow interest rates set by the country's central bank. So what happens? People are more encouraged to spend and discouraged to save. And when people are encouraged to spend, what do? They tend to have more money to invest in the markets. So generally, when you see speculations on rate cuts and when rate cuts really happen, right, markets will take off. Which is essentially why, since the start of the year, the S&P has made new all-time highs every other month. Because the Federal Reserve, they are saying that, they're hinting strongly that they are going to cut rates as early as September. Okay, so markets are really confident on that, and that's why they know that borrowing becomes cheaper, all this speculation, which is why you see markets taking off. So in US, rate cuts may happen because of slowing economy, that's right, yeah, because of a recession, fears of a recession. But stock market is on the rise due to this, hence the stock market doesn't necessarily represent the current state of the economy accurately. Exactly. Yeah, it doesn't really represent the current state of the economy, but it's sort of like a precursor. It's I would say, a forward predictor of where the current economy is. Right? S&P, I'll show you a chart again. Now, the entire reason why we are seeing this drop over here is the investors believe that the US is entering into a recession. And generally, the first indicator of a recession is you look at a downtrend in that country's stock market. And this happened on Monday and Tuesday before rebounding strongly because of the weak reports on jobless claims, meaning that less people are getting unemployed, which is easing concerns of a recession. Shout out to all our gatherer members: Andrew, Wendy, Edward, Alex, CC, Iz, Urshad, Caveman, Kelvin, Tommy, Jinkang, Adrian, JS, Wenyan, Dean, Duhan, Sufi, Faris, Alan, Jackson, Raizan, Hudson, G, Jeffrey, Lawrence, Lukman, Will, Jack, YC, Arif, Hazik, Jinden, Adam, Adrian, Ashley, Sean, and Jason, as well as all of our learner members. Thank you guys so much for joining. I will see you guys in the next session next week. Bye. Good night.